Okay, so a lot of you are following my channel to hear my analysis on the latest macro trend and the investment strategies in accordance with the macro data. During the past months, I have been uploading macro analysis videos, which hopefully would have helped you to make better investment decisions. Now, through those videos, I showed you how I analyzed the latest macro trend and used them to our advantage to predict how the Federal Reserve may take actions, and further, how the market will react in accordance with the Fed's expected actions. I also consistently emphasize that familiarizing yourself with the macro trend is the most important factor when it comes to investing in the modern economic world, especially after the 2008 financial crisis. I'm sure you guys listen to my videos carefully and try to learn how you can interpret the macro data. Now, while I've been uploading market update videos periodically, a lot of you guys said in the comment section that you guys would like to get a very basic overview on how to read the macro data. Now, this is a very broad topic, and it took me some time to think how to do this in the most efficient way possible. The reason it took me a lot of thoughts is due to the following. Number one, every macro data are generally not independent and somewhat correlated with each other. What this means is that we can't just look at each macro data one by one, but we need to look at them all together to get a holistic picture of the current status of the economy. Number two, there are so many data that is thrown to the market. It is our job to pick and choose which data we'll be focusing on and use them to our advantage. Number three, data can have different versions of numbers. For example, key data like unemployment rate or the CPI will have its officially announced numbers, but some other institutions may develop their own methodology of coming up with their own number for the same metric. Now, with all those considerations, I decided to make a video which is very basic for beginners with the following caveats. Number one, I'll focus on explaining the key data one by one. Now, given this is a very basic introductory video, I'll not take into account of every implications a data may have, but only focus on that single number and what implications that single number may have on the market. Number two, I'll focus on 10 key data which I focus on. Now, there are millions of data which we can monitor, but realistically, we can't monitor all of them. However, I can assure you that if you monitor the 10 key data, which I'll explain, you'll be covering around 80 to 90% of the macro economy. Number three, I'll focus on official data only. Now, the reason I only monitor the official data is because the whole reason we do macro analysis is to predict the Federal Reserve's actions. Now, the Federal Reserve monitors the official data, so while we may monitor other versions of the data, it won't be too helpful in forming our view on the Fed's actions. Therefore, I'll only focus on the official data. Number four, now, in order to leverage the macro data to your advantage when investing, please refer to my stock investing strategy for beginners video. What I'll be explaining today is just basic concepts of macro indicators and how those indicators impact the Federal Reserve's decisions. If you actually want to use them to your advantage when investing, please refer to my other video for more details. Now, having that said, before we begin, all the macro data can be found on key economic news websites such as Yahoo Finance or investing.com. Make sure you turn on the alerts for economic data from those websites so that you can get the latest data real time. Okay, let's begin. Now, when we look at the economy, the key data which represents the output of all the activities that happen in the world comes down to the GDP. You may remember that I explained multiple times that a GDP is composed of four components, which are C, G, I, and X. Now, C stands for consumer spending, G stands for government spending, I stands for investments, and X stands for net exports. Now, in recent years, the GDP growth was somewhat subdued, with the growth being in the range of somewhere between 2% to 3%. However, while the GDP growth is the outcome of all the activities that happen in a country, GDP growth itself doesn't really mean much, as it's just a resulting number. What really matters is the data that is behind the GDP growth, which are released on a weekly or monthly basis. Now, for those data, if I had to group them in a few categories, I would categorize them into, number one, job market related data, number two, inflation related data, and number three, economic activities related data. Now, the reason I group the data into these three categories is because these three topics are what the Federal Reserve monitors closely. Basically, the Fed has its own moving targets for each of these categories of data, and by forming your view on each of these components, you'll be in a pretty good position to predict what actions the Federal Reserve will take. Okay, now, behind each of the categories, there are 10 macro data which I closely monitor. First, on the job market, the data which I monitor is number 1, unemployment rate, number 2, initial jobless claims, and number 3, non-farm payrolls. Next, on inflation, the data which I monitor is number 1, the year-on-year CPI, number 2, the year-on-year core CPI, and number 3, the month-over-month PPI. Next, on the economic activities, the data which I monitor is number 1, the ISM manufacturing PMI, number 2, the ISM non-manufacturing PMI, number 3, Chicago PMI, and number 4, consumer confidence index. Okay, so as I said previously, I believe that if you monitor these 10 macro data periodically, you'll most likely cover around 80 to 90% of economic activities. To help you understand the implications of each data better, let me go into the data one by one to explain what these mean. Okay, first on the unemployment rate. Now, this is a very straightforward concept. Basically, unemployment rate measures the percentage of total unemployed workers who are actively seeking for a job versus the entire workforce. Now, generally, the unemployment rate measures how active the job market is, which is a fundamental measurement of how the economy is doing. If the unemployment rate is low, this would mean that companies are generally doing well with their products being sold a lot to their consumers, which would provide the companies more room to hire more people. If the unemployment rate is high, it would be the vice versa. Now, the Federal Reserve and the government generally has its own target unemployment rate. In recent years, the Federal Reserve and the government generally views the economy to be fully employed if the unemployment rate is as low as 4%. Now, this 4% number is subjective, and there's really no strong rationale or backup to the number. But all we need to remember is that the Fed is focusing on this 4% number. Now, with this 4% number as the threshold, the market and the Fed generally views the unemployment rate like this. Over 5.5% unemployment rate means a weak economy. 4 to 5.5% unemployment rate means an okay economy, and under 4% unemployment rate means a strong economy. Now, for your information, there's really no hard rules or formula behind these numbers. Apart from the 4% target, I'm setting the high, normal, and the low numbers based on my interpretation of how the Fed and the government generally reacts to the numbers. So you can have your own version of the numbers, but just think of my numbers as a general guidance. Okay, now, when the unemployment rate is high or low, the Federal Reserve takes actions accordingly. As I said previously, while all economic data are correlated and impacts one another, everything else being equal, the Federal Reserve will take expansionary actions when the unemployment rate is high and take contractionary measures when the unemployment rate is low. Now, for your reference, when I say expansionary, what I mean is that the Fed will either cut the rates or conduct a QE. When I say contractionary, what I mean is that the Fed will either increase the rates or conduct a quantitative tapering. Okay, now the reason the Fed would take expansionary actions if the unemployment rate is high is because if the unemployment rate is high, this means that the economy is weak and corporates are performing bad. The Fed wants to bring the unemployment rate to their target level of 4%, so they would reduce the company's financial burdens by lowering the interest rate. Now, when the unemployment rate is low, the Fed would think that the economy is overheated and it may trigger an inflation. In this case, the Fed would try to cool down the economy by increasing the interest rate. Okay, so that was straightforward. Okay, now moving on to the initial jobless claims. Now, initial jobless claims represent the number of people who filed for unemployment insurance for the first time during the past week. This is a leading indicator of the unemployment rate and is released on a weekly basis. A higher number means that more people are losing jobs, and lower number means that less people are losing jobs. Now, while the Fed does not have a hard target for this data as well, based on the recent trend, you can generally assume that any number within the range of 250 to 350,000 to be a normal state. Anything above 350,000 would be considered high, and anything below 250,000 is considered low. Now, in recent months, this number was consistently below 250,000, and this is why the Fed was assuming that the job market is too hot to decrease the interest rate, although they changed their stance at the Jackson Hole. Now, just like the unemployment rate, the Federal Reserve's potential actions are the same. If more people are losing jobs, the Fed's actions will be expansionary, and if less people are losing jobs, the Fed's actions will be contractionary. Now, one thing I'll note at this point is that, as proven by the recent actions of the Fed, a single data, such as unemployment rate or initial jobless claims, does not determine the Fed's actions. Even if the job market is overheated, depending on political situations and other factors in the economy, the Fed may make different decisions taking into account of other circumstances. Please remember this. A single data does not determine the Fed's actions, but you need to take a holistic view. I'm only explaining the basic concepts of each data. Okay, now moving on to non-farm payrolls. Now, the reason this data is key is because this data represents the employment situation of the bulk of the entire industry in the US. The reason we exclude farming industry is because, number one, farming industry is highly cyclical, so it may distort the data. And number two, farming industry is only a small share of the total employment, which has a minimal impact on the overall economy. Now, having that said, while there's no hard rule on this one as well, you can generally consider that any number between 50,000 to 250,000 as a normal state. Anything above 250,000 would be considered high, representing a strong job market, and anything below 50,000 would be considered low, indicating a weak job market. Now, in this case, the Federal Reserve's actions would be the other way around. If the number is high, the Fed would think that the economy is strong and would take contractionary measures. And if the number is low, the Fed would take expansionary actions. Okay, now moving on to CPI. Now, CPI is the core measurement of inflation. Basically, it measures how much the price of goods and services increased for the consumers compared to the last month or the same month of the last year. Now, for this metric, while we need to monitor both the month-over-month CPI and year-over-year CPI, if I had to pick one, I'll look at year-over-year CPI, meaning that I'll look at the number which compares the price level of goods and services versus the same month of last year. The reason I look at this on a YOY basis is because generally, YOY CPI removes any volatility in inflation movements, which may be due to seasonalities or one-off factors. Also, YOY numbers are generally easier to communicate, which is more aligned with the Fed's target of 2%. Month-over-month numbers are naturally much smaller given it compares to the price levels of 1 month before, which results in small numbers like 0.1% or 0.2%, which is a bit harder to comprehend. Okay, now, as I explained multiple times, the Fed has a clear target for this number, which is 2%. Now, for this number, if the number is somewhere around 2%, you can consider inflation to be in a normal state. If it is over 2%, it should be considered a high inflation, and if it is below 2%, it should be considered a low inflation. Now, a small deviation from the 2%, like 10 to 20 basis point, may be okay, but generally, the Fed wants this number to be at 2%. Now, for the CPI, as you may be well aware, the Fed's actions will be contractionary if the CPI is high, and it'll be expansionary if the CPI is low. Now again, as proven by the recent actions of the Fed, a single data such as high CPI does not determine the Fed's actions as shown in recent months. Please take this into account. Again, I'm just laying out a general theory. Okay, now moving on to core CPI. Just like CPI, I would look at this on a year-over-year basis. The difference between CPI and core CPI is that from the CPI, core CPI removes the price levels of food and energy. The reason this metric strips out food and energy is because food and energy are the most volatile items within the components of CPI. Food and energy are highly sensitive to external factors like geopolitical situation or one-off natural disasters, and therefore, removing these two items, the Fed can get a more balanced view about the current inflation level. Now, apart from this point, the mechanism is the same as CPI, both on the economic impact and the Federal Reserve's actions. Okay, now moving on to PPI. PPI, which stands for Producer Price Index, measures the price change of manufacturing goods. Now, PPI is a very important metric given it is a leading indicator for CPI and core CPI. This metric basically measures the inflation from the producer's perspective rather than the consumer's perspective. What this means is that this metric measures how much the cost has increased for the companies to manufacture their goods before selling it to the consumers. Now, generally, if more cost is involved for the companies to make their goods, they'll pass through the increased costs to the consumers at some point, and therefore we can get a sense of how CPI will turn out to be down the road. Now, given this is a leading indicator and needs to be monitored real time, for this metric, I look at it on a month-over-month basis to get a better sense of how it's moving compared to the previous month. If you monitor PPI very closely, you can get a sense of how the CPI will be in the near term. Now, given this is comparing the price increase versus the previous month, if the number is in between 0% and 0.2%, it should be considered an okay inflation, while anything above or below that should be considered high and low. Now, on the economic impact and the Federal Reserve's actions, it is the same as CPI and core CPI. Now, before I finish off on inflation, while I didn't include it in the list, one other metric you may want to monitor is the core PCE index. While it's a very similar metric compared to the core CPI index, it covers a broader scope of items which the companies pay on behalf of the consumers, such as employer-paid healthcare, and is also adjusted for changing consumer patterns. Therefore, it's a more stable measurement of the inflation which the Fed prefers to base their decisions on. Okay, now moving on to economic activities. First on the ISM Manufacturing PMI. Now, ISM stands for Institute of Supply Management, and PMI stands for Purchasing Managers Index. Basically, this is a data based on a monthly survey conducted with executives in over 300 to 400 manufacturing companies. Now, this is the Fed's favorite leading indicator of the real economy, as the survey asks questions around new orders, production quantity change, employment, and inventories. Basically, it's a survey which tries to see if the manufacturing industry is doing well or not. Now, you don't need to know the details around the calculation of the index, but all you need to remember is that the number 50 means that the economy is at a neutral state, which implies that there has been no change to the manufacturing activity compared to the previous month. Now, the Fed looks at this index to determine how overheated or underheated the manufacturing industry is. While the manufacturing industry is only a small component of the US economy with around 10 to 12% share, it is still a very important metric given the manufacturing industry is generally a leading indicator of the overall economy. Now, on the economic impact and the Federal Reserve's actions, with the number 50 being the neutral state, we can generally assume that any number over 55 means a strong expansion in the economy, while any number below a 50 is a contraction in the economy. Now, on the Federal Reserve's actions, if the number indicates a strong expansion, the Fed will try to cool down the economy with a contractionary measure, and vice versa. Okay, moving on to ISM Non-Manufacturing PMI. Now, the non-manufacturing PMI covers the services sector, which makes up about 70% of the US economy, and therefore, it is generally the more important indicator in understanding the overall growth and inflation. The services sector generally includes the likes of education, financial services, retail, hospitality, and etc. Now, the price levels of the services sector are generally more stickier than the manufacturing sector, given most of the costs are human labor. Therefore, the Fed generally monitors this metric closely to plan their next moves on defending the inflation. Now, the measurement is generally the same as the manufacturing PMI, and the economic impact and the Federal Reserve's actions are the same as well. Okay, moving on to Chicago PMI. Now, while this metric is very similar to the manufacturing PMI, this metric focuses on the activities in the Midwest region. Now, the reason we look at this is because, number one, Chicago is a manufacturing hub in the US, which many companies supply products nationwide. And number two, historically, Chicago PMI has been acting as a leading indicator for the nationwide manufacturing PMI. Basically, Chicago PMI gives us a preview of how the ISM manufacturing PMI will look like in the next 1 to 2 months, given Chicago is the starting point of the manufacturing activities in the US. Now, On the economic impact and the Federal Reserve's actions, it is the same as other PMI data. Okay, moving on to Consumer Confidence Index. Now, this index measures the level of consumer confidence in economic activity. It is generally a leading indicator which the Fed monitors to get a sense of how the inflation and the unemployment will be in the future. It is measured through a monthly survey conducted with 5,000 households in the US, asking about their sentiment towards their income, employment status, and business conditions. Now, similar to the PMI index, while we do not need to know the details of the calculation, all we need to remember is that the number 100 represents a neutral state. Generally, if the number is in between 100 and 120, is considered neutral, while above 120 is considered a strong sentiment, and below 100 is considered weak. Now, the Federal Reserve will take actions accordingly. If the consumers feel that the economy is very strong, they would take contractionary measures, while they'll take expansionary measures if the sentiment is weak. Okay, so with that, I have covered all the key data which you need to monitor to understand the economic conditions. As I said previously, please note the following. Number one, a single data does not determine the Fed's actions. As we have seen very recently, despite low unemployment and high inflation, the Fed may decide to lower the rates if political situation or other economic data are not aligned. Number two, while economic indicators are helpful in understanding the macroeconomy, we always need to take further steps to predict the movement of the market. For example, in 2020, when the COVID news came out, all the prior economic indicators became useless as everyone had to make a fresh set of predictions on how the indicators will change due to the pandemic. We always need to monitor the news and adjust the economic indicators accordingly on our own. Number three, while I laid out 10 indicators to monitor, there are millions of other data which can suddenly be important at certain times, and one data may be more important than the other. For example, in recent years, CPI has become the most important economic data, but before 2022, no one cared about CPI. Okay, so with that, I hope you now have a better understanding of reading macro data. Please note that familiarizing yourself with the macro data only comes with time. So please carefully monitor the market to the extent you can, and gradually you'll get a better sense at analyzing the market yourself. I hope you enjoyed the video, and I'll be back with more videos very soon.